My name is Miles Yoshioka. I'm the executive with the Hawaii Island Chamber of Commerce. And again, thank you all for being here. Dr. Miller looks like really is able to draw a crowd because as I mentioned, we expect about 80 people in this session. So this event is being brought to you by our sponsor, our Topaz Special Investor member, First Hawaiian Bank. And we like to ask all of you, mute yourself during the presentation. And if you have any questions for Dr. Miller, feel free to enter them via the chat feature. And we'll be going over your questions later on. Just to mention, this event is being recorded and we'll be posting the presentation on our chamber YouTube page in about a week or so. Did want to mention our sponsor, First Hawaiian Bank, has provided some great prizes, which we're going to give away at the end of today's session. So stick around, must be present to win. So we'll see you guys at the end. I'd like to call on our chamber treasurer, Laura Sonoda. She's First Hawaiian Bank's Assistant Vice President and Commercial Banking Officer, and she's over at the Waiakea branch, the Prince Kuhio Plaza one. And Laura, mind saying a few words and introduce our guest?
Sure thing. Thank you, Miles, and thanks, Taylor, as well, for helping put this together. We thought that having an economic market update would be useful for our business community, and we really do appreciate the opportunity to talk to you all today. First Hawaiian Bank, we continue to be an advocate for small business, and we are the largest bank in Hawaii. We're also the largest corporate foundation donor in the state. Along with our annual employee giving campaign in 2020, we actually provided over $5.5 million in grants and donations to over 200 community nonprofit organizations. And then when COVID-19 hit, our bank also donated or dedicated over 200 of our employees who volunteered to work on the PPP loan application process just to help push through as many requests as possible in order to assist our local community. And just to give you a little bit of background on the PPP, the approved lending through May 2021 nationwide amounted to just over 11.5 million loans being approved. $795.9 billion were funded. And as far as First Hawaiian Bank goes, in 2020, we funded approximately 6,000 of those loans, which totaled just under $1 billion. And then in 2021, 4,000 loans, which totaled almost $500,000. And of those, approximately 3,300 loans, totaling $130 million, were under $150,000. So those went directly to our smallest island businesses to assist them. And all of the loans went to Hawaii business, and these efforts were, represent more PPP funding secured for our small business customers and their employees than any other bank in Hawaii. So that being said, and without further ado, I'd also like to introduce Ken Miller, CFA. Ken Miller is our Senior Vice President here at First Hawaiian Bank. He's our Chief Investment Officer and Manager of the Institutional Advisory Services Division for First Hawaiian Bank. Ken has 25 years of financial sector experience, and before joining First Hawaiian, he was a Senior Research Analyst at JP Morgan Securities and a management consultant with McKinsey & Company. Prior to his business career, he was also a physician in clinical practice. Ken holds an MBA with distinction from Cornell University and is a CFA charter holder as well. He's the Director and Vice President for CFA Society Hawaii, and a board member for the University of Hawaii Foundation, the Pacific Asian Center for Entrepreneurship, and Kahala Nui. Thank you for being here, Ken.
Well, good morning, everybody, and thanks, Laura, for that kind introduction. I'm going to try and share my screen now. I'm more of a GoToMeeting than a Zoom person, but hopefully I can do this without sharing my email with everybody. But here we go. Right. Okay, can everybody see that? Right. Okay, we can see that now? All right, excellent. Thank you. It's an interesting time to be doing a talk like this. We're not only experiencing a once-in-a-century pandemic, but you could equally say that this is a once-in-a-century sort of an economy. Last year's economic collapse was really without parallel going back to the Great Depression. And this year, we're in the middle of a fiscal expansion that we haven't seen since the New Deal. So everyone is wondering what happens next. To jump ahead a little, here's the general message that we're going to give. As always, there's risks, but our baseline expectation is that neither the pandemic nor the burst of inflation that we're experiencing currently are going to be enough to derail the economic recovery. The state of Hawaii and the Big Island will enjoy that same recovery, but at a slower rate than the US as a whole. And as for the markets, assets that are tied to economic growth, for example, the stock market, should continue to do okay. So here's the agenda. We're mostly going to talk about the national economic picture, also talk a bit about the state of Hawaii and the Big Island, an update on the COVID-19 pandemic, a little bit about the market outlook for primarily for stocks and bonds, and then some time at the end for Q&A. But let's start by putting this recession that started last year in some historical context. The 2020 pandemic recession was nothing like we've ever experienced before. We lost nationwide around 22 million jobs almost instantly. And then we had a big surge in payrolls, which began in May, continued over the summer, and started to slow down in the fall. Today, we're still about 8 million jobs short of where we were before the pandemic started, which is still close to where we were at the depths of the great financial crisis, which itself dwarfed anything we'd seen since the Great Depression. Another characteristic of this recession is how uneven the effects have been. Everything that we did in face-to-face or in groups became almost impossible during the pandemic. So service industries like travel, hospitality, restaurants, entertainment were the most affected. But consumers still had a lot of money to spend. So with relief checks in hand, they were still buying stuff. And so certain categories like home improvement and appliances were really flying off the shelves. And the manufacturers of those goods have been doing relatively well. Now that we're emerging from the pandemic, the service-based industries are joining the manufacturing area to drive a very strong bounce back in growth. So these are the numbers from the International Monetary Fund, sort of summarizing the global outlook. A couple of things to notice. In the column 2020, world economic growth, the world economy contracted at around 3.3% in 2020. That's the worst going back at least 50 years. Then in 2021, the forecast is for 6% global growth, which is also the fastest since the early 70s. So really, for many of you on this call, these are growth rates literally that you've not seen in your lifetime. For the US itself, the forecast is for around 6.5% growth, which is the fastest since 1984. Really, the growth prospects for the US have improved quite a lot over the last few months. Last July, the Congressional Budget Office forecast that while the economy would grow, we wouldn't be returning to full capacity of the economy, what's called potential GDP, at any time, even over the next 10 years. Now, with the update in February, that outlook has been considerably upgraded. It shows us catching up to full potential economy in 2025. Now, since that update in February, the economic data has trended a little bit weaker. In particular, the April payrolls number was quite disappointing. So tomorrow's jobs report for May is going to be very closely watched. But clearly, the prospects have improved a lot. The two main factors, of course, being the improvement or hopefully the end of the pandemic, but also the policy response. So starting with the monetary policy, the Fed provided very strong and very timely support for the economy, having learned some lessons from the great financial crisis. So interest rates were very quickly brought down to zero, and then a whole bunch of other facilities were opened up to help make sure that credit markets didn't freeze up like they did during the great financial crisis. So these things were clearly been very helpful. But I think even a bigger effect has been the fiscal stimulus. So the CARES Act last year added about $2 trillion in fiscal support, which was about average as a proportion of GDP with the other developed market countries. But since then, with the year-end budget deal in December that added another $900 billion in fiscal stimulus, and then the passage of the American Rescue Plan of $1.9 trillion, it's really taken us into a different league. And in total, around $5 trillion in fiscal support. It really dwarfs anything we did in the great financial crisis. That's in the lighter green, shorter columns. The US there is on the far left. And with this extra support in the light gray, has taken us into a different league beyond the other developed markets. So this has clearly been a great support to growth. But is there such a thing as too much of a good thing? You don't hear a lot about belt tightening these days from either political party, but investors have clearly noticed, and you can see it in interest rates. So this is the yield on the 10-year Treasury, which has been on a pretty steep upswing since the fall, and steeper this year. There were two legs up, marked here by arrows. The first one on the left coincided with the Georgia Senate runoff election, when it became clear, a little surprisingly, that the Democrats were going to hold the Senate and so have unified government. And then the next leg up came with the anticipation of the American Rescue Plan, as the size and the scope of it, and the realization that it was going to be passed through budget reconciliation rather than through normal order. As those things came into view, investors had to upgrade the amount of fiscal stimulus that was likely to happen going forward. And so interest rates rose and inflation became much more of a concern. And then right on cue, we've had this burst of inflation in the April numbers. When you think about where we were a few months ago, there was a lot of uncertainty about whether the vaccines would be effective, what would happen in the election, what kind of fiscal measures would take the place of the CARES Act, where many of the measures were expiring in the autumn of last year. Now we have a lot of visibility on all of those issues. And what's taken its place as the sort of top of mind for investors has been inflation. So in April, we saw CPI go up 4.2% over last year, the highest we've had since 2008. And core inflation was up 3%, the highest since 1995. Now, it's not hard to find reasons for this burst of inflation. Basically, we've had a lot of pent-up demand and a surge in demand as the pandemic conditions have improved. And that demand is meeting some supply bottlenecks. Supply chains have been disrupted. There's a difficulty in hiring in many sectors right now. And so this supply-demand imbalance is causing inflation. On top of that, the effect has been magnified by what's called the base effect. Many prices went down a year ago as the pandemic came on. Inflation is reported as a year-over-year number, so that base effect is having an effect too. The real question is this burst of inflation going to continue, or is it going to be temporary? And I'm going to spend a few slides dealing with this because it's really the biggest issue facing investors right now. So one way to look at this is to take a sort of bottoms-up approach. Look at CPI sector by sector and ask yourself, is the increase in prices, is it related to the pandemic or to temporary factors, or is it likely to last? So if you do that, you'll see that by and large, the elements of CPI that have had the biggest impact clearly are related to the pandemic. Things like car and truck rentals, energy commodities is slightly different, but used cars and trucks, appliances, airfares, and so on. As you go down the list, near the bottom, there's a category called shelter, which actually hasn't moved very much. But I listed here because it's a very big part of the index. In itself is around a third of the index. Right above it, whiskey at home. That's a very tiny part of the index. I just listed it because to some of some of us it's important. But digging a little deeper at a few of these areas, the used cars prices started to go up last year, but there was a big burst in April, almost 10% in a single month, related to demand for cars coming out of the pandemic. And I think it's fair to say that there's no reason you would expect used car prices to continue to go up at these kind of extraordinary rates. Airfares in red is a good example of the base effect, where airfares went way down last year when nobody could travel. Now we're seeing very sharp gains year over year. But when you go back to 2019, the gains don't look very dramatic at all. And then the third category here, restaurants, is interesting because prices never really changed all that much, maybe a little unexpectedly. I think you could trace the reason to that there was a large amount of support through a PPP for that sector and for other factors. Now, restaurants are having trouble getting employees back and are starting to see wage inflation there. It hasn't translated yet into CPI, but it'll be interesting to see what happens. And this could well be a sector where we see more sustained inflation. But overall, I think the picture is not one that paints an overall environment of rising prices. What about home prices, though, which I mentioned before? You probably know that home prices also have been going up very strongly. And as I mentioned before, an important part of CPI. But home prices themselves do not go directly into CPI. Instead, this category called shelter is basically rent. And for people who own homes, it's homeowners equivalent rent. So do those higher home prices translate into higher rent? Well, maybe a little surprisingly, they actually don't. There's not much relationship between home prices and rent. And it's a good thing too, because if a third of CPI corresponded to what's been happening with home prices, then we would be seeing very, very strong inflation that was likely to go forward. Another way you can look at inflation is kind of from a top-down lens. And I'm particularly talking about inflation expectations here. So economists are very focused on this. When expectations of inflation get baked in, it tends to be a kind of a self-reinforcing cycle. And so it's something that the Fed and the economists watch very closely. There's two main ways to get a handle on this. One is through survey data, and the other is through market-based measures like this, which is what's called the TIPS break-even rate. And I'll take a second to explain this because it's pretty important and it's likely something you're going to continue to hear about. A TIPS is a Treasury inflation protected security. It's just like a regular Treasury in that there's a coupon, but it's different in that there's a second payment that comes every 6 months as kind of a catch-up for inflation. So the coupon yield for these two kinds of treasuries the gap between them corresponds to investors' expectations for inflation. It's called the break even. And you can see that that gap has been widening out over time. So if you just measure the width of the gap, which is what this chart does, you can see how inflation expectations have been going up, and they've gone up above the 2% level, which is the Fed target for inflation, and are now at around 2.5%, the highest since 2012. But on the other hand, this is not really a terribly high inflation rate. It's fair to say inflation that the Fed would have liked to have seen these kind of expectations all along, because the fight really has been against too low inflation rather than too high. The other way to gauge inflation expectations is surveys, like I said, just to ask people. And survey data has not really moved very much. This is the University of Michigan Consumer Survey. It showed 3.1% inflation expectations in March. For April, it's gone up a bit more. But it appears that these survey reported inflation rates respond very strongly to the headline inflation that consumers see around them. So if they pay a lot to fill up their car at the gas station, or the grocery bill is high, they translate that into higher inflation expectations going forward. But then when headline inflation goes down, expectations go down too as well. So generally, you'd say that expectations of inflation have become much more anchored now than they used to be around the Fed targets. So it's difficult to know how to interpret exactly what these consumers mean for inflation going forward. There's a third top-down way to look at inflation, which is that of monetarism. So, most is closely associated with Milton Friedman. Now, I'm no Milton Friedman, but I can tell you that the general idea is that inflation is caused by an excess of money in the economy. And that's certainly proven true at various times in various places. This example is Brazil during the mid-1990s, and you can see this very close correlation between the money supply in blue and inflation in the red color. Now, with the Fed buying 120 billion per month in bonds, there's a rapid expanse of the monetary base. Milton Friedman would have said, well, that means inflation is coming. But the relationship, at least in the US over the last 40 years, seems to have broken down. So really, there's no relationship today between the money supply and inflation. You could say that the role of money in the economy has changed with lower interest rates. I don't want to get into all the details now, but suffice to say that the amount of money circulating in the economy and its effect on GDP is described in this thing called the velocity of money, and that's really plunged over the last few years. So the bottom line is, if you're pinning your case for higher inflation going forward on the money supply, you're on kind of shaky ground, because it hasn't been a very good predictor for the last 40 years, at least in the US. Now, if you're a pensioner living on fixed income, obviously inflation is important to you, but why does it matter so much to the rest of us? Well, basically, it's because inflation is the thing that's going to cause the Fed to tighten monetary policy. In other words, to take away the punch bowl. And so the timing of when the Fed is likely to start raising rates is really a paramount concern to investors. The markets here, the market implied expectation from the futures market sees that rates will start going higher in 2022. The Fed says they don't anticipate starting rates higher until 2024 at the earliest. So who are we to believe? Well, neither the Fed nor the market have been very good at predicting the future interest rates, and generally they've been predicting rates higher than they eventually turn out to be. I'm betting that we're in the same situation today. In other words, that the market anticipating rates to start rising next year are probably too early, too aggressive, too hawkish on what's actually going to happen, and that rate hikes will actually be further out. Part of the reason I feel this is the Fed has a very high bar for raising rates. Basically, they've said that they're not going to be raising rates until we're at full employment, unless there's a sustained inflation well above their target. Now, we're a long way from full employment, even though unemployment's at only 6%, which is not that high from a historical perspective. As I mentioned before, we're still down over 8 million jobs from where we were before. So unless we really see a sustained high inflation rate, I don't expect the Fed to be raising rates. I've tried to make the case that I think this is going to be a burst of inflation rather than sustained inflation. So bottom line, no rate hikes this year or next, in my view. One last thing about inflation and the fiscal stimulus behind it, which is the longer term effect. And I don't think we really have time to get into this right now, but clearly at some point, and you in the Chamber of Commerce would know better than anybody, that at some point the piper will have to be paid if we continue with this debt spending. But what's not clear is exactly when that point will be. We have the example of Japan, which runs much, much higher levels of debt compared to us as a proportion of GDP, and still have very, very low interest rates. So the bottom line here is, I think this is not something you can forget about, but it is something I think you can put aside. It's not something, in my view, that should be driving near-term investment decisions. So let me turn now to Hawaii. I want to caveat this by saying that this is my personal views. I've also borrowed liberally from Yuhiro, from the University of Hawaii, and from their forecasts. But I thought I could round up a few things that might be of interest to you. So first of all, going into the pandemic, it was clear that Hawaii was going to be strongly affected because of the structure of our economy. We were predicted to be, among the top couple of states affected, and that's exactly how it's turned out to be. And in fact, almost a quarter of Hawaii's jobs disappeared in an instant as we went into the pandemic. Unemployment spiked from 2 to 22%. In Maui and Kauai, unemployment reached over 30%. Honolulu and the Big Island were relatively less affected, although still very much affected. But even today, after a lot of recovery, Hawaii is still about 100,000 jobs short of where we were before the pandemic. And our unemployment rate for the state at 8.5% is the highest in the country. So we basically went from the lowest in the country at 2% to the highest at 8.5%. The outlook is that Hawaii's recovery is going to continue, but as I mentioned before, at a lower pace than for the U.S. As a whole. So the Congressional Budget Office sees us reaching not full potential growth of the economy, but back to where we were pre-pandemic in 2022. For Hawaii, that probably won't come until a year or so later. But this in itself is a big upgrade from where we could have been. The fiscal support has been a key factor for that. So construction, looking here county by county, has actually managed to be pretty strong, and the fiscal support was helpful for that. But the outlook mostly hinges on tourism, and we are seeing a good bounce back there. Maui is now almost 75% on a seasonally adjusted basis, almost 75% of where we were pre-pandemic, and somewhat lower growth rate in the Big Island and Kauai. Honolulu, relatively lagging because Honolulu much more dependent on international tourism, which I think is going to be weaker, as I'll explain in a moment. And just another word about Kauai. Of course, they had their own local responses to the pandemic. That's tended to delay their recovery well behind what Maui's experienced. But international tourism, relatively more important to Oahu, is going to lag. This is a survey from the UN where they asked 200 respondents in 70 countries about the rebound that they expect in tourism. 84% of them said it'll be 2023 or later before they reach pre-pandemic levels. So worldwide, I think tourism, international tourism is going to suffer. So Hawaii, for the time being, has to rely on domestic tourism, but fortunately, we're very well positioned. Hawaii is very popular with the mainland. Here's a little stat I like to show. It's really the most popular state in the country. In a very simple kind of simple sort of a survey. So going forward, I think we're going to continue to see a pretty good recovery, but slower than the mainland overall. This is county by county, and shows us through 2023 recovering, but still lagging where we were. And this is the publicly available information from UHERO, but I did see that the figures out through 2025. It shows the same general pattern, even through 2025, shows payrolls a little bit below where we were pre-pandemic. In contrast, incomes, I think, are doing relatively well. Personal income actually went up very sharply in 2020 and are going to stay up in 2021, again, because of fiscal response. Sorry, this is mislabeled. It's indexed to 2019, not 2018. But then we're going to see a big fall off next year as those fiscal measures expire, then some growth again in 2023, but taking us to right around, or actually a little ahead of where we were pre-pandemic. So to summarize it, these are the figures from UHERO and from the state government. I want to draw your attention to a couple of things. If you look at 2021 column, for the real GDP number, the UHERO forecast is 3.7%, the state forecast of 2.7%. So this is a lot better than was forecast earlier, but still well behind the US overall, where growth is going to be around 6.5% in 2021. So I want to turn now to COVID pandemic for just a moment. Thankfully, the fourth wave that we were starting to experience in new cases really didn't amount to much. Clearly, the effectiveness of the vaccines, and we never really had an increase in the number of deaths, thankfully. But worldwide, the picture isn't nearly as rosy. Still, the world is very much in the grips of the pandemic. The focus has shifted from North America and Europe now to South America and Asia, ex-China. So we're very much in a race to try and get the world vaccinated before new variants emerge. And that is the risk. Virus variants arise pretty predictably. It's a natural byproduct of the way viruses reproduce. Fortunately, the mutation rate for the virus that causes COVID-19 has a lower mutation rate than other RNA viruses like influenza, for example. So that's helpful. And the fact that we have quite effective vaccines is helpful, but it's still a risk. So the US has been doing a relatively good job in the vaccine rollout. Now around 40% of the overall population is fully vaccinated. That puts us well ahead of the world overall and well ahead of Asia and Africa. There's still obstacles, though, around the world in the manufacture and the distribution of the vaccine, and of course, the hesitancy to take the vaccine itself. This is data from the US. It shows that around 25% of the country is unwilling to take the vaccine. Fortunately, we don't need 100% take-up rate for the vaccine. A lot of people have achieved immunity or some type of immunity through exposure to the virus itself. And it may be, depending on what you believe about how many people have actually been infected, that we're on that threshold or in the herd immunity stage already. We don't really know how many people have actually had COVID. We know there's about 33 million reported cases. There's some multiple of that of actual cases. The CDC estimates around 4.5 times as many people have been infected than have been actually diagnosed. If that's the case, it takes us up to around 150 million people and would put us solidly in herd immunity territory. So let me finally turn to just a little bit about the market outlook. So We've talked a lot about the inflation and the pandemic. These are clearly still risks, but in my view, the positives outweigh the negatives. If we look by sector, what's happened recently, there was kind of a tipping point right around the election. It wasn't just the election, but that's when we first started getting this very positive data about the vaccines. And so the stuff that had done the worst during the pandemic has been doing the best since then in terms of financial performance. So things like airlines, for example, second from the top, have had this big bounce back. The main message here is, though, that it's not a secret that we're bouncing back, and you can't just invest in these sectors thinking that they're going to do well, because largely it's priced in already. But the market overall, I think, may well have room to continue to run up. One reason is there's a lot of pent-up demand, not only for services, but for assets. That very high personal income, high savings rate has left U.S. Consumers with about $2 trillion in excess funds right now. It hasn't been invested by any means. A lot of it is sitting in bank accounts and in other forms of cash. And so this is potentially a major tailwind, as are earnings. I mentioned we have 6.5% growth. Earnings for the S&P 500 will probably be 23% or higher this year. This is a key driver for the stock market. Now, the main non-economic risk is related to valuation. The market is expensive. Sorry, I've just had something. Excuse me. Excuse me. I should lock my door. Okay. So the market is expensive, but that's not to say that the market can't go up. If you look back to the last time the market was this expensive, it stayed that way for years, and you have to consider the context, the very strong earnings growth I mentioned, and also the fact that we have very low interest rates. So markets can continue to go up. Valuation doesn't really tell you much about the near term. On the left, the scatter plot plots valuation versus market returns over the ensuing year. And there's really no relationship. So market could go up, could go down. If you look at the right, that looks at the return over the next 5 years. There's a much stronger relationship. So the bottom line here is that the market can continue to go up, but we should temper our expectations for the market over the next several years. And this is my final slide. And basically, it's reminding you that the general trajectory of the U.S. economy are long periods of expansion with relatively short, sharp recessions. And in that, financial assets tend to correlate with this fairly well. Your baseline position should generally be to be invested and to have exposure to the market, unless you have very strong reason to believe that we're on the threshold of one of these recessions. That's possible, but I don't think we're in that position today. And so we're still at our default position, which is to remain invested in the market. So that's all I had. I'm going to endeavor to stop sharing my screen now. And I hope you can see me again. And I'd be happy to take any questions.
Thank you so much, Ken. Yeah, so we're going to just do a Q&A session. If anyone has any questions, please send them in the chat. And any questions that aren't addressed during the program will receive a response later. So I did have a question from Chuck Erskine. He's asking, what's driving the hot real estate market when our visitor industry was basically closed? Historically, we've seen real estate prices dip anytime we've experienced an economic decline.
So the rise in home prices is really a nationwide phenomenon, and I think it is related to COVID, and appears to be one that's going to last for some time. So there's been a strong preference for people to get out of condominiums and sort of urban areas, going into suburbs, to smaller cities, and to remote places, relatively remote places like Hawaii, as a response to the pandemic, and partly because there's going to be a shift and has been a shift to working at home, so more people feel that they can work from Hawaii and still do their jobs. So that is a part of it. Of course, we have this very low interest rate environment, which is keeping mortgages very low. And I think that some of the surge we've had really recently, it may have been a little bit of expectations that interest rates were going to go up. So people wanted to get in and get the mortgages, fixed rate mortgage in before that happened. So I would call it a combination of things, but to really a nationwide.
All right, thank you. We have another question asking if you would be able to comment on the long-term cascading impact on economic recovery due to supply chain, supply and demand in connection to cybersecurity issues.
I'm sorry, could you say that again, Laura? I didn't quite catch that.
Mm-hmm. Yeah, if you were able to comment on the long-term impact on the economic recovery in regards to supply chain, supply and demand in connection to cybersecurity issues.
Okay, thank you. So I don't know a great deal about this. It's really, we've had some very dramatic cases of ransomware recently. It looks like basically companies are choosing to pay the ransom right now. So we're in quite a fraught situation. It doesn't appear that the efforts at cybersecurity have been particularly successful. So I think this is quite a risk going forward. Could be more supply chain disruptions. I can't quantify it for you, but I think it's a good question because it's a new risk that we haven't really had to deal with that much previously, and now appears to be much more to the forefront.
And we have another question. Even with the projected growth rate of 6.5%, do you feel the Fed will keep rates low for the next couple of years?
Yeah, so as I said in my presentation, that's the $64,000 or $64 billion question, but I do think they will. And I base that, again, because what will cause the Fed to raise rates will be higher inflation. They believe that we're having transient inflation now. I believe that too, for the reasons that I laid out there, which is both a bottom-up view and a top-down view, looking at inflation expectations and trying to weigh the impact of the expanded money supply. So, but it's clearly a risk. I could well be wrong on this. There's strong reasons to believe that we may see inflation in the future, but overall, I think we're likely to see the boost of inflation we have now go down, and which will stop the Fed from raising rates in the next couple of years.
All right, and we also have, what is the nature of the impact of a Biden infrastructure bill passage on construction prices, projected inflation, and Fed response?
Okay, another good question. First of all, we don't really know what the infrastructure bill is going to look like. We already, I think the price tag has gone from 2.3 trillion down to 1.6 trillion or something like that. Still huge, but it's very much a moving target. But let's assume that there's a substantial infrastructure bill going forward. I think it will tend to, I mean, it's not going to be all paid for by itself. There's still a significant deficit spending part of it, which will tend to raise debt and raise inflation prices, will tend, even separate from that, tend to raise prices for construction materials and so on. But you also have to remember that we're not talking about 1.9 trillion or 1.6 trillion to be spent in 2 years. This would be out over a decade or so, which would make the effects less. So in summary, I guess it depends on the final size of the bill. It depends on where the funding is. How much is deficit versus new taxes, and how long the spending is spread out over.
And then we've got another one. Do you think the service sector, for example, food and beverage, visitor industry, will rebound soon? Many companies are struggling to fill positions, even in other fields. Has the increase in UI benefits impacted the return to work, or has life-work balance shifted during the pandemic, which may be impacting these sectors?
Yeah. So another great question. I think that the impact of the expanded unemployment insurance benefits really has had an effect in this sector. I've heard it from enough people anecdotally now that I'd have to say that is a significant contributor for restaurant owners, and you guys know much better than me, having trouble hiring people. It'll be very interesting to see what happens in September when those expanded benefits expire. Just as an aside, I don't know what it's like on the Big Island, but on Oahu, there's a huge shortage of Uber and Lyft drivers now. And my impression strongly is that's related to the higher unemployment insurance payouts now. And in the relatively low-paying jobs, those employment benefits have a bigger effect. Nationwide, I don't think it's quite as huge a deal as it's made out to be. Some of these other factors where people want to stay home with their kids when they don't have childcare. In some cases, a lot of people have taken early retirement, and maybe this speaks to the life-work balance that we were talking about. So there's a variety of factors, but I do think the unemployment benefits are part of it. And ultimately, I feel funny, speaking to an audience like this, but ultimately, I think wages have to go up, and that's going to for restaurant owners who are having trouble getting staff. They may be forced to pay higher wages and to raise prices, and so I think it's been delayed, but we're likely to see inflation in that sector, in the food away from home sector, for those reasons.
Thank you. We have another one. Do you have any idea, let's see, do you have any idea what might Hawaii do best to diversify the economy?
So I'm afraid I don't have any brilliant ideas that haven't been talked about for 30 years. Clearly, it would be desirable, especially when something like the pandemic hits, to have a more diversified economic base. But I know that this is a challenge that Hawaii's been facing for decades. I would say overall that Hawaii should continue to do the best it can with where we have competitive advantages, which is clearly in the tourism sector. We also attract a lot of federal government spending and so on, related to where we're situated geographically. But realistically, I think the state should devote a lot of efforts to trying to make tourism better and more sustainable and more balanced with its effects on the community, except that it's an area that we can really compete in worldwide, and try to make the most of it. Now, great, if we can develop a sort of a STEM ecosystem here, that would be great. But there's lots of other places are trying the same thing. All kinds of tax incentives have been tried. It's very difficult. Generally, economies do best when they concentrate on what they're best at and where they have competitive advantages.
Okay, thank you so much, Ken. If there are no other questions, if anyone submits any in the chat later, we can make sure that those get answered. With that, I wanted to just turn it back over to Miles for prize giveaways.
Okay. I get the fun part. I get to give away prizes. So all of your names have been entered into a spin the wheel. Figured that's the easiest way and the simplest way to, and the fairest way to give away some prizes. So we have, thanks to First Hawaiian Bank, we have 4 of these reverse inverted folding umbrellas. That's so that when you fold it up, you don't get wet. And also we have 3 of these, cooler bags. I'm trying to, this is not working. Wait, hold on. Oh, wait. No. Okay. It's made out of canvas. It's gray and black. It has a fabulous First Hawaiian Bank logo in the front, and it easily holds a 12-pack. Wink, wink. Okay, so we got 3 of those, and we also have, thanks to First Hawaiian Bank, 3 $25 KTA gift cards. Okay, so I'm going to ask Taylor for her help. And this first one is going to be for, let's start with a $25 KTA gift card. Going to Lucky Mike Miyahira. Okay, Mike, stop by our office. Yeah, all of these prizes will be available at our office. So stop by. We'll give you an email to remind you. Okay, let's do another KTA gift card, $25. This one's going to Nathan Colgrove. Congratulations, Nathan. I did see your name. And we'll have it here for you, Nate. And then our third and last KTA gift card. Leslie Isemoto Contracting. Congratulations, Les. Okay, let's give away some umbrellas. Not that we need it today, but we have 4 of them. So the first one's going to Daniel Kea. Congratulations, Dan. Okay, let's give away one more. Deanna. Congratulations, Deanna. We'll connect with you and have it available for you. Congratulations. Oh, Deanna, are you on? If you are, give us a shout. Okay, everybody go, so you can tell Deanna that she could have won. So since Deanna's not on, let's give away our second one to second umbrella. Going to Amy Honda. Fly the logo proudly. Okay, and I think we're on our third umbrella. Okay, Wes Sigawa. Hey, Wes, are you there? No, I don't think Wes is on. Okay. Okay. So our third one going to third umbrella. Peggy Farias, WH Shipman. I know the WH Shipman folks are here. Peggy's probably with Heidi. Peggy? Peggy? Chime in. Heidi, chime in. Okay, let's keep going then. So I guess we're still on our third. See, let's get
Sorry,
to.
Miles. I'm
Oh.
sorry. I couldn't figure out my unmute. No, Peggy's not with me.
Okay. So
She
Peggy
had to
saw
drive
you.
to Waimea this morning, so she couldn't make it back. Sorry.
Okay, thanks. So we have our third one still available. Still trying to give away a First Hawaiian Bank foldable umbrella. Ed Haura. We have a lucky Ed Haura. I know Ed's with us. Congratulations, Ed.
Thank you. Thank you.
Okay. Our last and final umbrella going to Dean Uemura. I saw Dean's name out there. Dean, you're there, right? Dean was there. Oh, okay, right on. Congratulations, Dean. Thanks for the reply. Okay, so we have 3 cooler bags, which I'm trying to share and show. It's still black and gray. It still has a great First Hawaiian Bank logo on it, and it still holds a 12-pack. So our first one is going to Richard Henderson. Senator, are you there? Oh, maybe Senator didn't make it today. Couldn't make it. Richard, are you out there? Okay, guess not. Let's go look for another winner. Mike Kalekini. I saw Mike out there. Mike, chime in if you're there. Mike? Ooh, Mike lost out. Okay. We still have 3 cooler bags left to give away, so let's find another winner. Taylor, find me a winner. Oh, Mike is here. Okay. Thanks, Mike. You get the first one. James Takamine gets the second one. James, are you there? James, are you with Lynn? Or Lynn, is James with you?
Hey, Miles, sorry, no, he's not with me, and I don't see him logged in, actually.
Okay, thank you. Okay, so we have 2 more left. This next one's going to Shannon Wibberly. Shannon, part of our Young Professionals group. Shannon, chime in if you're out there. And Gordon is still waiting patiently. Okay, looks like Shannon wasn't able to make it. So this is, the second one is going to Glenn Kagamita. I know Glenn is out there. I saw Glenn earlier. Okay, great. Our last one, our last and
Thank
final.
you. Thank you.
Good excuse to stop by the office, Glenn. Okay, so our last cooler. The lucky winner is Antonia from RLB. I saw Antonia earlier.
Hi, thanks. Thanks so much.
Congratulations. Okay, everybody, that's it for the prizes. Thank you all for joining us. I'd like to thank Dr. Miller, Laura Sonoda, Chuck Erskine from First Hawaiian, and First Hawaiian Bank for the generous donation of prizes. Have a great rest of the week, everybody. Have a great Aloha Friday. And again, we'll see you next time. Aloha.